If you are getting ready to sit for the Nebraska Life Insurance Producer Exam, this video is built for you, and it covers one thing: what Nebraska does differently. The national material you are studying elsewhere teaches you how life insurance works everywhere. What you are about to hear is the Nebraska layer on top of that, the state law and state numbers that the exam draws from when it wants to know whether you studied this state or just the general concepts. We will keep pointing at the test, naming the numbers you have to memorize, and flagging the places where Nebraska parts ways with what you learned nationally. Assume nothing here repeats the national course. Every minute is Nebraska. A quick note on how the test is built, because it shapes everything that follows. The Nebraska exam mixes general insurance questions with a slice of state-specific ones, and that state slice is where points are won or lost by people who otherwise know the material cold, so when you hear a number in this video, treat it as something to lock in, not something to nod along to. We will repeat the ones that matter. Every rule we cover traces back to one office, the Nebraska Department of Insurance, led by the Director of Insurance. The Director is the person the statutes empower to license producers, approve policy forms, examine company books, investigate complaints, and hand down penalties when someone breaks the rules. When you see a question that asks who has authority to do something in Nebraska insurance, the answer is almost always the director or the department. Not a board, not a commissioner, not a federal agency. Here is a distinction the exam likes. Before an insurance company can sell anything in Nebraska, it has to hold a certificate of authority, which is the department's permission to do business in the state. A company that holds one is an admitted insurer. A company that does not is non-admitted. Why does this matter to you as a producer? Because of the safety net we will discuss near the end of this video. The Nebraska Guaranty Association protects policyholders only when an admitted licensed insurer fails. Sell a policy from an unlicensed company, and that protection simply is not there. So the certificate of authority is not paperwork trivia. It is the line between a protected policyholder and an exposed one. The director also supervises the financial side, the capital and surplus a company must keep on hand, and the periodic examinations of an insurer's records. You do not need the dollar thresholds for the exam, but you do need the concept. Nebraska regulates insurer solvency on the front end so that failures are rare, and backstops them with the Guaranty Association on the rare occasion they happen. Let's recap before we move on. The Director of Insurance runs the show. A certificate of authority makes an insurer admitted. Admitted matters because guarantee protection follows it. Hold on to that, because it pays off later. Studying for your insurance licensing exam? Check out the My Insurance Guide flashcards app, built specifically to help you pass your insurance licensing exam with confidence. Master over 1,000 expertly curated flashcards across every insurance line. Built-in spaced repetition brings back the tough terms right when you need them, and timed practice exams prepare you for the real thing. Click the link below and download today. Now, back to the video. To hold a Nebraska resident producer license, you must be at least 18 years old, maintain your principal residence in Nebraska, be trustworthy and financially responsible with a good reputation, and pass the licensing exam for your line. That is the full gate, and one thing on that list surprises people. Nebraska does not require a mandatory prelicensing education course. Many states make you sit through a set number of classroom or online hours before you can test. Nebraska does not. Prelicensing study is strongly recommended, and most candidates do it because the exam is hard, but the state does not legally require it. On your exam, if a question implies Nebraska forces a prelicensing course on you, be suspicious. The resident producer license fee is $50. We will say that again, because fees are exactly the kind of small number the test likes to swap. $50 for a resident producer license. After you pass, your results move from PSI to the department in a couple of days, and you apply for the license itself through the National Producer Registry. Now, a license alone does not let you sell for a company. You also need an appointment, which is the formal authorization from an insurer to represent it. When a company appoints you, it must file that appointment with the department within 15 days of the date your agency contract is signed, or your first application is submitted, whichever comes first. Remember that number, 15 days, and remember that the company files it, not you. One more housekeeping rule that shows up on exams. If you move or change your business address, you must notify the department within 30 days. Miss that, and you can face a fine. So, 2 numbers leave this section with you: 15 days for an appointment filing and 30 days to report an address change. Nebraska licenses run on a 2-year cycle, and the renewal date is tied to something personal: your birthday. Your license expires on the last day of your birth month, in the year your age is divisible by 2. So if your age is even in even years, you renew in even years. If your age is odd in even years, you renew in odd years. The takeaway is simply that renewal rides on your birth month on a biennial schedule, not on the calendar date you were first licensed. You may renew in the 90-day window before expiration. Miss the deadline, and there is a 30-day grace period during which you can still renew, but you will pay a late fee of $50. Let those 2 windows sit side by side: 90 days before, to renew on time; 30 days after, to renew late with a penalty. If you let even that grace period lapse, the license expires, and your company appointments are canceled. You can still get the license reissued without retaking the exam if you act within 12 months of expiration. Go past 12 months inactive, and Nebraska makes you sit the exam again. That 12-month line is a favorite exam target, so anchor it. Continuing education is where the numbers cluster. A resident producer must complete 24 hours of approved continuing education every 2-year period. And of those 24 hours, 3 must be ethics. Say it as a pair: 24 total, 3 of them ethics. No licensee is required to complete more than 24 hours in a 2-year period, and credits do not carry over to the next cycle. Here is the relief valve newcomers love. You are exempt from continuing education for your very first renewal. The clock on those 24 hours starts after that. 2 product-specific training rules attach to life producers. Before you can sell annuities, you must complete a one-time 4-hour annuity training course. And if you sell long-term care coverage, there is separate long-term care training. We will come back to the annuity training when we reach the best interest standard, because they are tied together. For now, lock the core numbers: 24 hours every 2 years, 3 of them ethics, first renewal exempt. Nebraska gathers its rules against bad sales behavior under the heading of unfair trade practices, and the exam expects you to recognize the named ones. Misrepresentation means making a false or misleading statement about a policy. False advertising is the same idea aimed at the public. Defamation is making a false statement that damages another insurer. Boycott, coercion, and intimidation cover strong-arm tactics that distort the market. And unfair discrimination means treating people in the same risk class differently on price or terms when there is no actuarial reason to. Each of those is its own prohibited practice, and a question may simply describe the behavior and ask you to name it. Rebating deserves its own moment. A rebate is giving a client something of value, part of your commission, a gift, a special favor that is not stated in the policy to induce them to buy. Nebraska prohibits rebating. The reason behind the rule is fairness. If one buyer can negotiate a kickback, identical buyers are no longer treated identically, and that undermines the whole risk pooling idea. Know that Nebraska does allow certain narrow exceptions for things of nominal value, but the default you carry into the exam is simple: rebating is prohibited. Then there is controlled business, a term that trips people up. Controlled business is insurance written on the producer's own life or property, or on the producer's immediate family, rather than on the public. Nebraska's concern is that someone might get a license only to pocket commissions on their own household's policies. So, the law limits a producer from being licensed primarily to write controlled business. The test for you is recognition. If a scenario describes a person seeking a license mainly to write coverage on themselves and their relatives, that is controlled business, and that is exactly what the rule restrains. One clean conduct rule to finish on: commissions may be paid only to properly licensed producers. An insurer cannot pay commission to an unlicensed person, and a licensed producer cannot pass commission to an unlicensed agency. If a question dangles a payment to an unlicensed party, the answer is that it is not allowed. Two Nebraska acts round out the conduct rules, and both are consumer protection tools at heart. The first is the Insurance Fraud Act. Insurance fraud is knowingly presenting false information to obtain a benefit or payment that is not owed, whether that is a padded claim, a faked loss, or a misstatement on an application made to deceive. Nebraska treats it as a serious offense with real penalties, and the director has authority to investigate it. For the exam, the concept to hold is that fraud requires knowing deception for gain, not an innocent mistake. The second is the Privacy of Insurance Consumer Information Act. When you take an application, you collect sensitive personal and financial information, and Nebraska law restricts how that information may be collected, used, and shared. The principle behind it is that a customer's private data belongs to the customer, and an insurer or producer holds it in trust. So a scenario where a producer casually shares a client's health or financial details without authorization is a privacy violation. Think of fraud and privacy as two sides of trust. One protects the company and the system from the dishonest insured. The other protects the honest insured from careless handling of their information. Here is a place where Nebraska states a clear rule, and the exam tests the edges of it. As a baseline, you cannot take out a policy on another person without two things: that person's written consent and an insurable interest in their life. Insurable interest means you would suffer a genuine loss, financial or emotional, if the insured died, and in Nebraska, it must exist at the time the policy is issued. Now, the exceptions, because that is where the trap questions live. A husband or wife may take out a policy on the other spouse, and any person may take out a policy on a child. Outside of those, the general consent rule controls, and a policy on a child or another individual must have its benefits payable to that insured, their estate, or someone who actually holds an insurable interest in them. So, picture the scenario. Someone wants to insure a coworker they barely know and collect the benefit themselves. No consent, no insurable interest. Benefit pointed at the wrong person. That fails on every count. Compare it with a spouse insuring a spouse, which the statute expressly allows. On your exam, when a consent question appears, run it through that filter. Spouse on spouse and anyone on a child are permitted, strangers are not. A small but tested point. This consent requirement is about individual policies. Group life and blanket coverage work differently and are carved out of this particular rule. Keep that distinction handy. This is the heart of the state portion, so we are going to go slowly and repeat the numbers. Nebraska law lists provisions that every individual life policy delivered in the state must contain, and these are the figures the exam returns to again and again. Start with the grace period. Nebraska gives the policy owner a grace of 1 month to pay a premium after the first year, and during that month, the policy stays in force. Most national material teaches grace periods as 30 or 31 days. Nebraska's statute phrases it as 1 month, and during that month, the company may charge interest of no more than 6% on the late premium. If the insured dies during the grace period, the policy still pays, and the company simply subtracts the unpaid premium from the benefit. Picture it. A premium was due, the owner did not pay it, and 11 days later, the insured dies. Is the death benefit payable? Yes, because the policy was still inside its 1-month grace period, and the insurer deducts the premium that was owed. Next, the free look, also called the right to examine. Every individual life and annuity policy in Nebraska, except credit life, must let the purchaser return it within 10 days of delivery for a full refund, no reason required. 10 days. We will say that again, 10 days, and notice it covers annuities too, which we will revisit. When the policy is returned in that window, it is void from the beginning, as if it had never been issued. Now, incontestability. After a Nebraska policy has been in force during the insured's lifetime for 2 years, the company can no longer contest it for misstatements in the application, except for non-payment of premium and a few narrow limits. 2 years. The reason behind the rule is to give the insurer a fair window to investigate, while protecting beneficiaries from a company digging up an old application error after a long-standing policy pays out. On your exam, if a misstatement is discovered after the 2-year mark, the company generally cannot void the policy over it. Reinstatement is the one people confuse with grace, so separate them now. If a policy lapses and its value has gone to buy other insurance, Nebraska lets the owner reinstate it within 3 years of the default, provided they show evidence of insurability and pay the back premiums with interest. 3 years to reinstate. Hold the contrast in your head. 1 month of grace to keep a policy from lapsing. 3 years to bring one back after it has lapsed. The exam loves to swap those two numbers, so if you see 1 month for reinstatement or 3 years for grace, something is wrong. A few more required provisions worth knowing by name. Misstatement of age. If the insured's age was stated wrong, the benefit is adjusted to whatever the premium actually paid would have purchased at the correct age. The policy is not voided, the amount is simply recalculated. Entire contract. The policy, plus the application if attached, is the whole agreement. Statements by the insured are treated as representations, not warranties, so an honest mistake will not automatically void coverage the way a breached warranty would. And claims. When a policy becomes a claim by death, the company must settle upon receiving due proof of death, and no later than 2 months after that proof. 2 months on claims. Nebraska also adds a consumer protection step on lapses. For policies issued on or after January 1, 2026, the insurer must send a notice at least 15 days before the policy lapses for non-payment, to the owner and to any assignee on record. That date is part of the rule, so keep it. Policies from January 1, 2026 forward carry a 15-day pre-lapse notice. Finally, Nebraska prohibits certain provisions outright, including backdating a policy beyond what the law allows, so a company cannot quietly antedate a contract to its disadvantage to the owner. Let's recap the numbers from this section you must lock in, because this is the densest part of the whole exam. Grace, 1 month. Free look, 10 days. Incontestability, 2 years. Reinstatement, 3 years. Claims paid within 2 months of proof of death. And the newer 15-day lapse notice for policies issued on or after January 1, 2026. Mix these up, and you will lose points that are entirely avoidable. Group life follows its own set of required provisions in Nebraska, and the exam expects you to notice that some numbers shift when you move from individual to group. The grace period is the clearest example. A group life policy carries a grace period of 31 days for any premium after the first, and the coverage continues during those 31 days. So contrast it directly. Individual life grace is phrased as 1 month. Group life grace is a flat 31 days. If you studied national material, that 31-day group figure will feel familiar, and Nebraska keeps it. Group life also has its own incontestability rule, and it matches the individual side at 2 years from the policy's date of issue, again, except for non-payment of premium. And group coverage carries conversion rights. When someone leaves the group, they generally have the right to convert to an individual policy without proving insurability, within the window the policy sets. The reason behind conversion is practical. A person who loses group coverage, perhaps because they change jobs, should not be left uninsurable, so the law gives them a bridge to an individual policy. On your exam, if a group member is leaving and worried about losing coverage, conversion is the concept being tested. Quick recap: group life grace is 31 days, group incontestability is 2 years, and departing members get conversion rights to an individual policy. Carry the 31-day group figure separately from the 1-month individual figure. Replacement is when a new policy is bought and an existing one is dropped, lapsed, or changed to pay for it. And Nebraska regulates it tightly because replacement is where buyers get hurt. The concern is that a producer might talk a client out of a perfectly good policy just to earn a new commission, leaving the client with a fresh contestability period, new surrender charges, and lost benefits. So, Nebraska requires a defined replacement process. When replacement is involved, the producer must give the applicant a replacement notice and submit the proper paperwork, and the existing insurer gets a chance to respond and provide information about the policy being replaced, including a policy summary or in-force illustration. Failing to follow the replacement rules is itself treated as an unfair trade practice, so this is not optional courtesy, it is law. 2 disclosure tools support honest sales. A buyer's guide explains in plain language how the type of policy works, and a policy summary lays out the specific costs and values of the policy being sold. Nebraska requires these be provided so the buyer can make an informed choice. Then there are illustrations, which are the projections of how a policy's values might grow over time. Because illustrations can mislead if they overpromise, Nebraska regulates how they are presented and requires that non-guaranteed elements be clearly labeled as not guaranteed. And advertising of life insurance and annuities is the insurer's responsibility, even when a producer creates the ad. So the company must maintain control over what goes out under its policies. The thread running through all of this is informed consent. Buyer's guides, policy summaries, illustrations, and replacement notices all exist, so the customer decides with the facts in front of them. On your exam, if a producer skips the replacement paperwork or hands over a rosy illustration without flagging what is guaranteed, that is the violation. Annuities are where Nebraska has tightened its rules, and this is prime exam territory. Under the Nebraska Protection in Annuity Transactions Act, when you recommend an annuity, you must act in the best interest of the consumer. That is a higher bar than the older suitability-only standard, and it is built on 4 obligations. The care obligation means you exercise reasonable diligence, skill, and judgment to understand the consumer's situation and recommend something that genuinely fits. The disclosure obligation means you tell the consumer, in writing, about your role, how you are paid, and the products you can offer. The conflict of interest obligation means you identify and avoid letting your own financial interest, like a bigger commission, drive the recommendation. And the documentation obligation means you keep a written record of the basis for what you recommended. Here is a subtle point the exam may probe. Acting in the consumer's best interest does not make you a fiduciary. Nebraska's law is explicit that the care obligation is a regulatory duty, not a fiduciary relationship. So, if an answer choice claims the producer becomes the client's fiduciary, be cautious, the standard is best interest, but the statute stops short of calling it fiduciary. Remember the training rule we flagged earlier? This is where it lands. Before you can sell annuities in Nebraska, you must complete a one-time 4-hour annuity training course covering annuity products and this best interest standard. 4 hours, one time, before you sell. And annuities get the same 10-day free look we covered for life policies, so a buyer can return an annuity within 10 days of delivery for a refund. One more tested detail. When you are recommending that a client replace or exchange an annuity, part of acting in their best interest is considering whether they have already done another annuity exchange within the past 36 months. Frequent churning of annuities is a red flag the law wants you to weigh. Let's recap the annuity numbers and concepts. Best interest standard, 4 obligations, care, disclosure, conflict of interest, and documentation. Not a fiduciary duty, a one-time 4-hour training before you sell, a 10-day free look, and a 36-month look-back on exchanges. Variable products deserve a short, separate stop because they are regulated by 2 masters at once. A variable life or variable annuity puts the policy's values into investment sub-accounts, so the value rises and falls with the market, which makes them securities as well as insurance. That dual nature means dual oversight. the federal securities regulators and the financial industry's self-regulatory body govern the investment side, while the Nebraska Department of Insurance governs the insurance side. For you, the practical exam point is licensing. To sell variable products in Nebraska, holding a life insurance license is not enough by itself. You also need the appropriate securities registration, which in practice means passing the relevant securities exams, and you must hold or apply for the life license alongside it. So the rule to carry is that variable products require both an insurance license and securities registration, because they are both insurance and investment at the same time. If a question suggests a plain life license alone lets someone sell a variable annuity, that is incomplete. The securities piece is required too. Earlier we said the certificate of authority matters because of a safety net, and here it is. The Nebraska Life and Health Insurance Guaranty Association steps in when an admitted, licensed insurer becomes insolvent and cannot pay what it owes. It is funded by assessments on the member insurers, not by the state, and it protects Nebraska policyholders up to set limits. Those limits are exactly the kind of dollar figures the exam tests, so here they are, and we will say the key one twice. For any one life, the association covers up to $300,000 in life insurance death benefits. $300,000 for death benefits. It covers up to $100,000 in cash surrender or withdrawal value on life insurance and up to $250,000 in the present value of annuity benefits. On the health side, it reaches up to $500,000 for major medical coverage. And there is an overall ceiling. No matter how many policies are involved, the association will not pay more than $300,000 in aggregate for any one life on combined life and annuity benefits, or $500,000 when health coverage is in the mix. One conduct rule rides along with the Guaranty Association, and it is a classic trap. Producers are prohibited from using the existence of the Guaranty Association to sell policies. You cannot tell a nervous customer to relax and buy because the state will cover them if the company fails. Using the association as a sales pitch is against the law. So know the limits, but never sell with them. On your exam, if a producer reassures a buyer by pointing to guarantee coverage, that is the violation, even though the coverage itself is real. Recap the limits to memorize: $300,000 for death benefits, $100,000 for cash value, $250,000 for annuity present value, $500,000 for major medical, and a $300,000 aggregate cap per life on life and annuity combined. And never ever use the association to make a sale. Let's close the content with what test day actually looks like, because knowing the format steadies your nerves. Nebraska contracts with PSI to deliver the exam, and you take it in person at a PSI testing center with locations across the state including Omaha, Lincoln, Grand Island, Norfolk, North Platte, Scottsbluff, and Sydney. The life exam contains 100 scored questions, and you get a 2-hour time limit. A small number of additional unscored experimental questions may appear mixed in, and they do count against your clock, but they do not count toward your score. To pass, you need 70%, which works out to 70 correct answers. Say it together: 100 questions, 2 hours, 70% to pass. The exam fee is $43, paid when you schedule, and it is not refundable and not transferable, so do not miss your appointment. Nebraska exams are open eligibility, which means you may retake the exam as many times as you need, though you pay the fee each time and cannot retest the very same day. A few test day specifics. Arrive 30 minutes early for check-in. Bring one valid, current, government-issued photo identification. An expired or temporary ID will turn you away and cost you your fee. You will get a brief tutorial that does not eat into your testing time, and your score appears on screen and by email the moment you finish. PSI sends your result to the department within a couple of days, and from there you apply for the license itself. If you pass, you then apply through the National Producer Registry. If you do not, you study the diagnostic report you are given and book another attempt. Recap the logistics numbers: 100 questions, a 2-hour limit, 70% or 70 correct to pass, a $43 fee, and arrive 30 minutes early with a valid photo ID. You made it through the Nebraska layer, so let's do one tight sweep of the numbers that win points, because these are the ones worth memorizing cold. Grace period, 1 month for individual life, 31 days for group. Free look, 10 days on both life and annuities. Incontestability, 2 years. Reinstatement, 3 years. Claims paid within 2 months of proof of death. The newer pre-lapse notice, 15 days, on policies issued on or after January 1st, 2026. Continuing education, 24 hours every 2 years with 3 in ethics, and your first renewal exempt, a one-time 4-hour annuity training before you sell annuities. Appointment filed within 15 days, address changes reported within 30 days, guarantee limits of $300,000 for death benefits, $100,000 for cash value, and $250,000 for annuity present value. And on test day, 100 questions, 2 hours, 70% to pass, a $43 fee. You know this state's rules now, and that is the part most candidates underprepare. Walk in steady, read every answer choice with the traps we named in mind, and trust the work you put in. You are ready for the Nebraska portion. If this video helped you feel more prepared, give it a like and subscribe so the next person studying for their Nebraska exam can find it too. Now go pass that test.